All right, there you go, and we're off, Brett. The Sentiment and Flow Show, the October 15th edition for everybody out there, and certainly an interesting week since we last spoke, Brett. We talked a lot about that, the expectations for the deal, and we'll continue to get into that because obviously we got a lot of strong commentary, but not a lot of strong follow through actions as of yet, right?
Yep, yep.
So
Surprise, surprise.
yeah. So that's going to be the key moving forward. But just I guess to break into it, what's your early take on this current action? Obviously, we're up at the high end of the range in the S&P, right around that 3,000 level. And for me, I don't. I think people might need to see some of that evidence that we were just talking about in the transportation and industrial sector to make sure that the business spend hasn't completely fallen off a cliff. But I really think that the market, in order to break out, I feel needs to be able to step in above this 3,000 level and find some buyers. Otherwise, we risk just slipping back down into that range bound pattern that we've really been in the last couple of months.
Yeah. No, I mean, I think that to contextualize a lot of the stuff that we talked about last week, I think is kind of coming to pass now in the form of really you had too much lean, too much of an assumption. I think if you want to put a narrative into place, it's we got this incredible set of yield curve inversions over the summer, and I think that we'd kind of gotten a shift back to lowering some of our recession forecasts after Labor Day weekend, and then we got that terrible ISM data, and I feel like there was a week or so in there where the predominant zeitgeist in the market was basically that was kind of a confirmation of what the yield curve inversions were showing us, and we're on the doorstep to some kind of recessionary shift. And who knows what it's necessarily related to? Maybe it's trade, maybe it's just the cycle being really old. And we've got a number of data points to talk about, including the new fund manager survey, which now at this
Yep,
point
a bunch of
90
shiny new toys for us, right?
yeah, about 90% of respondents said it's late cycle at this point, rather than what we've seen, where there's a lot of people who are still of the idea that if you look in terms of don't take the years, don't take the age, take the mileage. It's not the years, it's the mileage on the economy, and you could almost make an early cycle case if you look at interest rates. So now we're seeing 90% of people think it's late cycle, and I think that that's a consequence of those yield curve inversions paired with that ISM data, which was a recessionary number. So I think that's the context that we're coming out of now. And by that, I mean, one thing we talked about last week was to see a 10-day, and we showed this chart, the 10-day put call average on a closing basis being above 1.14 right in the kind of end tail following the ISM services number. And that was really what basically bottomed the market. And as we showed in that chart, that's been something that's been an enormously productive bottoming signal for the last 3 years, almost in every single case when it's happened. And so that shows that sort of panic lean, and it shows a panic lean that has built up over the course of a number of days of consistently, way more puts than calls being bought, and that shows an overhedging and an overlean in the market and an assumption of downside that's still coming. And as we, basically the fundamental thesis of the show is that when you have everybody all assuming that the same future thing is going to happen, by the positioning that implies, that future thing becomes impossible. So everybody positioning for further downside all at the same time made further downside impossible. And we're coming out of that context right now. And again, we'll get into more of the intricacies of the fund manager survey, but just to give a preview, it's back up to 5% cash in terms of what BofA is holding in its prime brokerage service for its clients. So that's a threshold that, generally speaking, is a sign that people are uninvolved. And if we're getting a spin on things now, regardless of the quality of the trade agreement, if we're getting a spin on things now that suggests that Trump is through escalating until the election, then that 5% cash is going to get worked lower, and we're seeing that today. And we're going to see a low bar, I think, for earnings. And Wells Fargo, you can talk more about this, but Wells Fargo seems to be, to me, a little bit of a symbol of that.
Yeah, and obviously I've spent most of my morning on those bank earnings. I was on all the calls. I wasn't on the Wells Fargo call, but basically Wells Fargo and Goldman were special cases because JP Morgan and Citigroup were certainly better than both of them. JP Morgan was showed why it gets the premium in valuations compared to peers. It just had a pristine quarter, and this is operating in a pretty difficult rate environment too. Now this plays into, Brett, what you're saying about the reduced expectations, and certainly highlighted here in the banks and what we're seeing with some of those numbers. You get in the dip in net interest income in a lot of cases, certainly in net interest margins, and but that was all kind of tapered in, and I think more than anything too, the idea that I don't want to call it transitory, but we have been seeing a little bit more of a steepening of the curve as of late in the markets. So that certainly bodes well for Q4 for these names, and a little bit of a cooling off on concerns there. Now for Wells Fargo and Goldman Sachs, Brett, as you were talking about, not great quarters, and they both saw pretty good reactions, but there's a lot of company specific there too that needs to be factored in. Wells Fargo, the idea that it was a kitchen sink quarter, as we were talking earlier this morning, Brett, and that there's a new CEO in town, and they were basically just doing all their write-downs on the books in order to clear the books for that. Certainly sets up for FY20 to be a much easier comp for the bank too, and that's going to be something that we're going to need to factor in. For Goldman Sachs, you got the transition to the consumer banking unit. They noted on their call that the Marcus Apple card, for instance, drew down return on equity 60 basis points as they launched that off. But, it's been a pretty strong credit card launch for both Apple and Goldman. Two pretty big heavyweights there, obviously, in the market. So you get those names beyond a credit card, you're going to find buying interest. Goldman Sachs' downgrade of Apple excluded, right? But so
Yeah.
so there you have the banks out, and commentary around the economy, around demand. Certainly not whistling past the graveyard, noting the risks. But the common thing I was seeing on the risks was that it was man-made, more or less, with the trade wars. And we'll also break into the IMF World Economic Outlook that was released earlier today, too, which highlighted the same thing. And then it goes back to what Brett just said, where there seems to certainly be a sign that we're not looking at any further escalation at this moment. Now, I guess, Brett, where I would send up a big red flag is if we get another incident like May going into that Chile summit, or what's expected to be the summit between President Trump and President Xi, and we get that May repeat where both sides are saying that the other reneged on the deal.
Yes.
And if that was the case, then I think that it turns into all-out trade war at that point.
Well,
I think
yeah. So let me point out two things. One, I just posted a chart to Tyler what Gavin was talking about the inversions starting to go away. The lead inversion is the 3-month to 10-year spread, and that's the one that led on the downside, and it just turned positive again, basically for the first time in almost 6 months at this point. So that just contextualizing everything you just talked about for the bank earnings, but also just as a general indicator, it should be taken note of that. Yes. The 10-year to 3-month just moved out of inversion territory. So,
any surprise that this is occurring after the Fed's reverse Operation Twist commentary?
No,
Okay.
yeah, no, not really. I mean, and if anything, if you want to take the QE Lite version of reality there, rather than the sort of technical mumbo jumbo version of reality, then that should be inflationary. So you should start to see steepening. But I mean, this plays into bank earnings, but it also plays into just general signals about the economy. And yeah, I what you just highlighted, the whole narrative here is still subject to, one way that I frame it to myself, just in terms of a heuristic, is who does China want to be the next president? And I think the marketing narrative coming out of you've got to remember everything. If we're going to go a little bit of politics here, everything out of this administration, you have to remember that this is the most media savvy administration probably ever. You've got the Treasury, the Secretary of the Treasury is a movie producer. Larry Kudlow's a TV star. The president is a TV game show host. It's a process of really catering to the ability to manipulate a media narrative well, and using that as a strength and saying that's part of the game of trying to manage politics in the 21st century, with such diverse kind of tribalistic environment. So that's there, and framing the narrative, and it's about what narrative is being put forth. What do we know from Friday and over the weekend and today that suggests here's the narrative that this very media savvy White House team wants to put out there? And I think that's what the market is reacting to. And I wrote about this in my notes yesterday and today, which is essentially the idea that there's a little bit of a have your cake and eat it too dynamic here. We don't really have any kind of a trade deal in place, but the fact that the White House is working so hard to market it as we just got phase one basically in place, and that leads naturally to phase two, which is more or less a formality. It will take a while to get into place. We'll have to dot some I's and cross some T's, but that's what's happened now. The big deal is happening. And it's just, we played this whole escalation thing out just right, and now we've started to do the paperwork. And that's the formality side of this. And over the next 18 months to 2 years, we'll roll out phase 1, 2, and 3 that will be the perfect deal to last this country and its relationship with China for decades to come. And I think that's what they're signaling, is that's the narrative that they want to put out there. And it's up to China as to whether or not they want to play along with that narrative. And I think that comes down to a choice that China is going to make to some extent about who it wants to deal with for the next 4 years.
The tough part, I would say, for China is you don't get those Democratic primaries until February, right?
Yes, that is the tough part.
And obviously Chile, and I don't think it's a surprise that the Trump administration was looking to kind of force China's hands on this at all going into ahead of those elections. My politics aside, if you're looking at the markets, this is how I think you got to see it. I think China fears Trump, but believes that they could get a deal. I feel like that they would fear Warren even more, because
possible.
Some of the things that Warren would be looking for in terms of human rights and stuff like that, they're not really measurable categories, and would be.
You're making the argument it's the devil you know.
It's the devil you know. Fair enough. But then, you got to think Biden, who
they love Biden.
They sure. Love Biden. So,
he worked with them he was the primary guy, right, for the Obama administration with China.
Right. And he's been the one, and I don't have Carmine around to recap this. Of course, we probably get a little bit more insight, hopefully, if they ask this question at the Democratic primary. They seem to always avoid the China tariff question, which seems to me to be a pretty key one. But Biden's the only one that said that he would prefer to move away from tariffs. Now, Warren has said that she'd prefer to take more of a multilateral approach on this with our allies in Europe and stuff. I don't know how easy that would be to get everybody on board. Certainly, the last 40 years doesn't suggest that would be all that easy. But comments from tonight's election or Democratic primaries certainly could play a part into China's thinking, as Brett was saying, because that's what they're trying to game plan right now. It's who do we have to deal with in 2021 and 2022, and can we get a little bit more of a favorable deal doing that? And in the meantime, if we need to buy 50 billion pounds of sorghum or whatever it is that they might be looking to buy, do they just kind of and I don't believe that there was a timetable put on that either, Prep, was there?
No, I don't think so. No.
So I mean, maybe they buy $1 billion each month, like China kind of do the slow walk to see who they'll be up against. So with that in mind, I do think that something will happen in November. Phase one, whatever phase one means of a bigger deal, at the end of the day, I think it's going to be positioned as a small deal, and I don't think you'll get any more concessions out of China. And I guess the question is whether that's going to be enough to allow the markets to move forward. Now, on the flip side, too, on the American side, they obviously you don't want to have a recession going in George Bush the first would probably give you agree with that sentiment. So I mean, I do think that the things are lining up to get a
Jimmy
decent.
Carter would agree.
Yeah, Jimmy Carter would be another one who would agree. So I do think things are lining up here in a positive manner. Um, but it's definitely going to be interesting to watch polls moving forward over the next couple of months and seeing if China's stance and peacocking kind of moves in line with some of these polls here.
Yeah, no, right. It's going to be. I think there's no way to get away from the notion at this point during this very strange time that political developments are absolutely the number one item that the market is concerned with, and it's for someone like myself who wants to trade on anything but the strange machinations of a single individual's mind and what they should choose to tweet or release as news at any given moment without plan. It's the last thing I'd want to see, but it is the case, and it just has to be integrated into your approach. And as I said a couple days ago, for people who started trading in the last 3 years, it's amazing to me to think in terms of someone thinking that this is normal. And that's how
Yeah.
it would feel if you've recently gotten into trading. You think that this is how markets generally are. That you generally have to take account to, there being a tweet from the White House that completely changes the landscape that the market is dealing with at any moment, and that's just incredibly unique and anomalous to this period in history. But it is 100% important to analyze. It's not a side issue at all.
All right. So, Brett, let's break into some of these reports that we have. I'm going to save the Fund Manager Survey and Flow Show for not for the end. That's going to be the majority of our conversations here. I just want to touch upon some of the other pieces here and get your thoughts on it. And we'll start off on the sentiment side with the Empire Manufacturing, which actually improved a little bit here. Was came in at 4. Expectations were for, I believe, it was -2. And this was up slightly. So this marks the second sentiment survey that we've seen for October. The first one, of course, being that Michigan consumer sentiment number, which came in
Right.
really strong.
Right.
And every bank is just hanging their hat on the strength of the U.S. consumer. Doesn't seem to be any break there at the moment. But taking a look at the Empire, I'm going to throw a few things at you, and you tell me what you
All
think
right.
of it. 6-month outlook improved a little bit, but remains subdued, with capex and tech spending index both improving.
Yeah, right. I mean, well, and it's always from what base of from where you're coming from what base of assumptions. This is an evolution of a perspective.
Right,
So I think that
and
it's a
it's
little
coming
bit
off
of
of a
like
3-year low too. So
it's coming off of a sense of, oh, the end is definitely happening right now, and then the sun comes up the next day, and then well, maybe it's not the end, and there's a herding around that recognition.
right, and I think we're starting to see that play out over the last few days here. And as we break into a little bit more of the actual flow data, you'll see where this has the potential to lead to. For Empire, general business moved up. No surprise there. That'd be the overall. New orders unchanged. So and remain at pretty low levels. So you take on that?
Yeah, I mean that's the closest thing to hard data that this report contains, right?
Yeah. Yeah, so I mean that would probably, although actually shipments too, and
Yeah.
shipments did
Okay.
jump up 7 points. Do you think that might have just been people kind of wait to see
It's
about
possible.
the next round of tariffs and
Oh, and it's so tough to say, right? I mean, where
yeah,
you and segmentation and reporting time frame, like it becomes sort of like a periodicity issue, probably for a data point like that. You need to see a trend.
right. Unfilled orders continue to decline. You see anything
What do
in
you
that?
mean? No, I don't.
No, not really. Here's one that did interest me, and as we're talking a lot about the transportations, delivery times increased, and from I'm just curious if that could be, a reduction in capacity by some of these transport names that are just, perhaps they reduce their capacity a little too much. And, I'd be curious to hear that theme going on in some of these calls JB Hunt this afternoon. But you got any thoughts on that?
No, I feel like that if I were to suggest thoughts on that, I would be speculating to a point where there's no basis for that speculation.
Right, which is what I just did, but I like speculating it. And again, it's more or less, I just wanted to point that out as we get on some of these calls. That could be a theme that we need to
Yeah,
look for.
sure, absolutely.
Inventory is unchanged, and for me, that's been a big thing because throughout this entire process, I do feel we've seen a pretty good, obviously the semiconductor space had some major inventory issues at the start of the year. Uh, from the Micron report, we'll get ASML tomorrow and some big ones next week with Intel and Texas Instruments and stuff. Inventory's unchanged. I think that's been a key theme that's been overlooked in terms of companies just doing a good job at managing the inventory base that they have, and that could always point to a quick turnaround if we see some of the dam breaking on these trade tensions. You have any thoughts on the inventory side?
No, I mean, obviously, one of the core cyclical aspects that you're always going to look at, and one of the things that really defines the whole Turtle Beach metaphor that I use, inventories is a huge part about that, because that really suggests when you are making assumptions about the future. If you build up inventories, and we see a trend in a number of different indicators that suggest that there is an assumption that tomorrow, in terms of demand, is going to be much better than yesterday, that tends to manifest itself in just accumulated inventories that end up being the problem. And then you start to have to cut back in other ways, and that kind of tends to lead on the downside when the cycle shifts. So I suppose if it were to persist and really become a dramatic issue, then that would be something really important.
Correct. Then the two quick ones: modest employment gains, hours worked increased. The hours worked I always like as a forward indicator, Brett, because from my point of view, the first thing people do instead of laying off workers is they might furlough them, they might cut back on their hours, particularly in where it's in a per hour basis. So I thought that hours worked increased was important in terms of maybe that employment number isn't set to fall off as some people have feared.
Yeah,
And then prices increased at a slower pace. Didn't really take too much from there. I think that's pretty much reflected in the data.
certainly.
So, all right. So, overall, not bad news from the Empire, as Brett said. There's a little bit of relativity in there. Something to be watched moving forward. But that's 2 October sentiment numbers. And Brett and I have talked a lot about the hard versus soft economic data, where the soft economic data seems to be improving. All right, then IMF outlook, Brett, just throwing that at you real fast. I don't know if you had a chance to take a look at it at all. To be honest, I just kind of took a look at some of the Cliff Note versions, but they reduced their outlook to 3% in 2019. It was at 3.8% at the end of 2017. It was at 3.3% just 6 months ago. So continue to take their numbers down, and pretty much a direct finger at the trade wars. And I thought it was interesting that they also said that the United States started too.
Yeah, it seemed to me to be a highly political update.
Right?
But
Yeah.
yeah, it was interesting from that perspective. And I suppose if you think of the IMF as holding the torch for the broader and inevitable trend of globalization over time, and making sure that course maintains itself, and global free trade being an important positive cherished by all, which personally I would agree with. They I suppose seem to take on the responsibility for maintaining that perspective to things. But as far as the headlines off of the predictions, it was interesting to see the comparison with the 2008 financial crisis, and a lot of maybe a little bit sensationalized
Yeah.
potential on the downside. So I don't know, but there is there's a case to be made there.
Sure. And I would say I don't think the IMF is the greatest prediction.
They don't seem to. No. So let's just both. So for there to frame it for everybody, yeah, Gavin and I have both noticed in the past that IMF shifts in forecasts have not tended to be the most accurate predictive mechanism for the global economy.
Right, and one of the reasons why I say that too is I found it interesting that they basically predicted that the U.S., China, Europe, and Japan would see slower growth over the next 5 years. It seemed like a pretty bold call for 5 years out for this particular
right.
piece.
And throwing China into that group, I thought was interesting. It seems very different reasons on the other side. The other three, we got an idea. You've got generally aging demographics and sort of overly mature economies, and then China thrown in there. Maybe
China does have the age.
The rest of the world is trying to prevent that.
Yeah. Pretty much when everybody else is trying to slow you down, I guess it's tough to keep chugging. Just ask Earl Campbell, right? So, we'll lead into the Fund Managers Survey now, Brett, because one of the things that I did think was interesting, and I've seen this in the Flow Show the last couple of times, is the plays for the decade of 2020. And I keep seeing emerging markets, but I feel like we get this at the beginning of every decade, no? Where emerging markets emerging markets are going to be the biggest area of growth over the next 10 years.
Well, I mean, yeah, it's kind of like saying, small cap companies are going to grow more. I mean, effectively. Yeah. But there's a very cyclical concept. I mean, if there is not a problem with debt servicing, if there's not a problem with an overvalued dollar, if there is genuine growth, then of course.
Yeah. And I don't know, I keep feeling like we probably get this every change of the decade, and one of these times they'll be right and be like, I told you so.
Yeah.
But okay, let's break into the Fund Managers Survey and get into some of the numbers that we've been discussing here. And right off the bat, as per usual, the sentiment's been bearish, despite what we've seen in credit and equity markets. Obviously, the trade war is there.
So let's just say you can almost take what you just said and say that we've said that almost every show.
Yeah, I think so.
For like 6 months.
When did we kick this off? In August?
Almost for 10 years. I mean, It's been that's the remarkable overriding thing that we're living through with this market cycle. Is just this amazing persistent pessimism despite asset price behavior.
It's funny because I'm in the midst of reading that Schiller book on narrative economics. If anybody gets a chance, I highly recommend it. But, it talks a lot about the dominance of the news cycle and how they kind of lead everything into, dragging on sentiment overall, because especially in today's day and age with Twitter and social media all over the place. But with that theme in mind, Brett, too, obviously trade war and Brexit fears were there. So their global growth expectations fell to minus 37% in the Fund Manager Survey. This is now the range has basically been minus 60 to 80 to plus 80 in the range over the past 25 years. So as we can see, it's near the lows. And again, Brett, you said that 90% of the people are saying that it's late cycle. And that this is the one thing that I didn't get, and I'd be curious as to your take, that fiscal policy is too restrictive. Now, I understand and completely agree with your European view on fiscal policy, but have you heard anybody complaining about fiscal policy being too restrictive, or do you think it's in reference just to the government's being able to pass it?
Yeah, I heard in this report from Bank of America that fund managers think so. That's it. Yes, you're right. That's it. So, but yeah, I suppose that is just simply the idea that if we have an ISM report like we just saw, if we have all these inverted yield curves, to have interest rates as low as they are already, and thinking globally, and we've got a population that this answer was the upshot of a population of people who are clearly investing in global assets, and they're looking around the world, and $14 trillion of sovereign debt is in negative yield territory. And monetary policy as a tool is kind of played out, and maybe in Japan and maybe in Europe. And the question is the United States next to kind of take on that the mantle of that sense, or that sentiment about policy tools and countercyclical behavior. But then what's going to step into that niche? And there's been very little other than the tax reform bill in the United States in late 2017. That was really a fiscal stimulus step, and it's the only real serious move in the major developed world that is a coordinated effort, except maybe you could argue with some of what Japan has done. But the idea that you'd think that politicians would be taking a much more proactive move, a much more proactive attitude about stepping into the gap that's been left by the skepticism about the potency of monetary policy tools at this point, given that interest rates are as low as they are. If you forget about where the stock market is, if you forget about the fact that we still have expanding economies, and you just simply look at interest rates, I suppose that fund managers would be looking from the standpoint of, we obviously there's not a fire lit right now, and the central banks aren't able to light one. So where is the next step? And I suppose that it's a relative determination. That too restrictive is just because there's not a next step. We haven't seen a lot of movement there.
Right. Okay. Next up, respondents saying companies should use the cash to increase capex. I found this interesting because this is the first time
Me
I've
too.
seen
I found
that.
that very interesting.
And just for a recap, the last couple of fund manager surveys were for paying down debt. Now they're looking to increase the capex,
which implies
that they want to see more growth coming.
Or that there is growth available. There's a market opportunity.
Right.
If only you invest, you will see a return. ROI will work out.
Right. And I found that to be one of the more interesting aspects.
It does not mesh with the 90% say it's late cycle. It
Yeah.
does not mesh with the 5% cash. It does not mesh with the negative 37% future growth expectation. I found that a very peculiar data point.
Yeah, so that's one that we're going to continue to track going forward because, like you said, Brett, that means people think that there's growth out there, and I was just kind of scratching my head given the rest of the data points we're seeing.
In an environment where you think the cycle is about to end and growth is about to decline, you don't start a new factory and hire a bunch of people.
Yeah.
Yeah, you don't, right? So if you believe that, then why do you believe that capital, unless it's just a reaction, unless it's just a built-up, pent-up kind of reaction among investors of, let's start using capital for something productive. Let's invest it in the business rather than just keep using it for buybacks and managing balance sheet. It could just be kind of almost like a reaction.
Right. So again, that's going to be something that we're going to continue to follow here in this survey. Okay, we're talking about the tail risks. 40% said trade war was the number one. 13% had monetary policy impotence and bond market bubble as it. And then 75% said that ending the trade war is the most bullish catalyst for stocks in the next 6 months. German stimulus would be after that. In terms of the tail risks, credit events doesn't come into number 4. And I agree with that because really I think it's 1, 2, and 3 that would kick off 4, right? So,
yeah, you're exactly right. Right, these things. I mean, do you see credit spreads widening? I don't.
No.
And I had a conversation with somebody else about this earlier today. Like when that's the signal. I think that if you see somebody saying it's late cycle, and this kind of speaks to the other issue. If you see somebody saying it's late cycle, if you see somebody saying, well, the economy is about to decline, but you look at where the corporate debt growth overall, size of market, interest rates, everything, spreads to risk-free rate, all of it, the whole complex. You look at where that situation is, it doesn't suggest a lot of actual concern about rising default rates. And you would think that the skepticism that appears in other places would suggest credit spreads should be starting to creep out there. I guess they're creeping out a little bit, but there's nothing that suggests true concern about a default risk that really is material. You're exactly right. If these other tail risks start, so it's really there's an apprehension about very clear, possible causes of death for the cycle, but the patient keeps living, and so the credit spreads stay tight.
Yeah, I mean, the way I figure it is when credit comes to the top of that list, we're already going to be into
Yeah,
a
exactly
recession.
right. Exactly right.
Because,
Put a pin in that comment.
yeah, yeah, exactly. So, okay, so move on. Overcrowded trade's pretty much been the same for a while now. Long U.S. Treasuries, long U.S.
Yeah.
tech growth. No surprise there. European government bonds, most overvalued asset class. But do you think that Greece going off at negative interest rates on their most recent bond sales could?
That is a surreal event.
I mean, you're paying Greece.
If anybody listening who remembers 2012 and 2011,
Yeah.
that just that statement is just incredible.
Insane. Absolutely insane. But 'tis the world we live in, right?
Just to phrase it, just to make sure it got out there, because I knew what you were going to say, but I don't know if I talked over you. Greece is in negative yield territory with its government debt.
Yes. So
We were at what 20% and default coming.
Yeah. Yeah, I mean,
completely unsustainable.
there were
future.
lawyers out there arguing that they technically defaulted. So I think that they had to get by on the selective default, I believe.
So the thirst for yield has driven the riskiest of sovereign assets that you could ever make up into negative territory, and I suppose that says something about confidence of the European Union holding together, and that there being a kind of fiscal pro quo.
Yeah.
So,
all right. Some of the top plays coming out for investors, we got cash, we got the REITs, we got the staples, and U.S. pharma, all deflationary plays. And the shorts are hunkering in energy, the UK, obviously, with Brexit, industrials, equities, and sterling, which are the inflation plays. So, again, that kind of plays into that sentiment and the flow data that we've been seeing here, Brett. Don't you think?
Yeah, no, right. I mean, it's sort of like bullish skepticism.
Yeah. So, and just continuing to, we've talked a lot about the rotation in defensive equities like healthcare and consumer staples, and out of the cyclicals like materials and banks. Okay, recession risk is still a top concern, tempering risk appetite, Brett. 31% of investors expect a recession over the next 12 months. First 67 who see a recession is unlikely. Now, I don't have the usual average for this, but my assumption is that it's probably closer to that 10%, right? Because you basically have 5% in any given year, and then a recession comes, I don't know what the exact years would be, once every 4 years, call it. But 31% is obviously pretty high on that recession risk fear, and kind of plays into some of the other numbers we've seen around sentiment in these surveys, right?
Yeah, absolutely. And it meshes with most of the other data that we see here. There's a few things that really stand out as odd, and we've mentioned a couple of them. But yeah, I mean, I think that's relatively in line for the way that people are approaching these questions.
All right, then I don't think this is odd because we talked about the yield curve and it starting to see a little bit of a steepening here. But the transformation of this I've found to be pretty interesting. 18% of investors expect short-term rates to rise over the next 12 months. This number was at 87% last year.
What was it a month ago?
A month ago, I don't have that number in front of me right here, but I was fascinated by.
I think it was about 9%. So I think we're
9%.
We're creeping back. Yeah,
so it's creeping back up. Okay, all right. Yeah. I was looking at that. I was thinking September 18.
One of the last 19, couple we had, I think, was like a multi-decade low in that indicator.
Okay.
Value. But still, yeah, there's the ultimate statement of transformation we've seen over the last year. You're exactly right. I mean, and it's one of the things, like when you think about the evolution of this cycle, as a process, as a movement from, on one end, ultimate risk aversion to on the other end, ultimate risk acceptance. It does kind of frame a feeling that there's a way to look at the economy to kind of having, in terms of that process, having topped a little bit in early 2018. And that's when we had people really believing that there was going to be a rejuvenation of interest rates and a normalization of the cycle, central bank normalization around the world. And we've sort of, from that standpoint, from the standpoint of central bank activity and interest rates, we've sort of melted back into a life support situation, even though equity prices don't really reflect that.
Right.
And I think sentiment on interest rates is a very direct way of seeing that.
Okay, no, that's a good breakdown of that. Okay, so we talked about the low growth expectations. When they were breaking down the survey, 9% of people said growth would get a lot weaker. 53% said a little weaker. 13% said stay the same, and 23% said a little stronger. 1% said a lot stronger. So as we can see there,
there's nobody positioned for a lot stronger growth. Just number one takeaway, there's nobody positioned for a lot stronger growth. If you believe in contrarianism at all, there's a vulnerability there. Your biggest asset moves will be, if we just happen to see a lot stronger growth, that will generate the most dramatic movements in asset prices.
And only 24% were for even stronger growth at this point too. So
right. Generally speaking, if we get a serious uptick in growth, we start to see some renewed, reinvigorated strength, so much so that central banks have to peel back off the gun a little bit, and it doesn't really impact that, which I'm not saying that's going to happen. I'm just pointing to the if-then flow. Based on positioning data, and this is why this data is useful, this is why the show is useful, based on positioning data, there's your biggest asset price movement. It would be to the upside, and it would be if we start to see much stronger than expected growth.
And here's the second potential misplacement in terms of people leaning way over in one direction. 4% of investors are expecting higher global CPI in the next 12 months. 4%.
And yet, the bond bull position.
Right. And I mean, and we talked a lot about deflation numbers. I was just giving out the deflation plays, the long cash, the REITs, the staples, the U.S. pharma, and then everybody's short energy, UK industrials, equities, sterling. So bottom line,
you can see the flip that could happen here.
Exactly. If you start seeing inflation creeping up,
a reflationary environment, generally speaking. Yeah.
Right.
A persistent one, a sustainable one. Not that is going to happen, but
yeah.
Again, but that's where the vulnerability lies in asset prices.
Yeah, that's where the big numbers can be made if we see a shift away from where we are. And I'd love to see one headline. I'd love to see these surveys and for them to go back the same day after we saw a headline about a German fiscal stimulus or something. I'd be real curious to see that. But this is the most bearish inflation outlook since July of 2012, if anybody's interested there.
That was when Draghi took the microphone and said,
"Yep,
the euro is permanent." What was the line?
The euro we'll do whatever
we'll do whatever it
takes. I'm trying to remember.
The euro is permanent, something like that. Yeah.
And I remember you saying anybody who's short the euro is going to get hurt or something too.
Yeah.
So I'll miss Draghi.
Back when the voodoo magic worked.
Yeah, I'll miss him. We only got a month left, and I miss Trichet too. So who knows?
Oh yeah, he was the best.
We got one compass.
Single needed compass.
Okay. Then investors are increasingly looking towards fiscal policy to boost growth. A record net 57% of the investors say they think global fiscal policy is too restrictive, compared to net 33% saying it was too stimulative as recently as November 18th. So we kind of talked a little bit about that part, but you got anything to add on to those numbers?
No, I mean, I think that they're just, they're looking for somebody to step up to the plate.
All right. Now, here's one thing that I know you've been hammering a lot, and one of your favorite metrics to look at. And we talked about this the last time we covered this survey. 30% of investors say they have taken out protection against a sharp fall in equities over the next 3 months. Now, this was down 4 basis points month over month. 58% said they have not been positioned. But I believe that 34%, Brett, if I'm correct, was a record high.
Yeah, but it is ticking back the other way, and it's just like it's just like everything that we're talking about here. There was a scare. We're going into recession right now, and just like that, this just like the Empire State Survey. Maybe there's a oh, everything is ending, and then the sun comes up the next day.
Yeah.
And you tick down a little bit. Oh, well, this isn't necessarily the end of the world, and now I'm not positioned well enough.
Yeah. So, I mean, we'll see how that plays out. Then, harkening back to that, investors want to see money used for growth. Credit cycle concerns remain elevated at net 48%. Again, just another number that just doesn't make any sense with that.
Doesn't make any sense. Look at credit spreads. Doesn't make any
Yeah.
sense.
So, and then this one for earnings. And then one last one before we go move on to the flow show. Global corporate profit expectations remain bearish despite improving 10 percentage points month over month to net 35% of investors saying they expect profits to deteriorate over the next 12 months. No
Hence
surprise
the
there.
cash levels. Yeah.
We've pretty much seen that. We're set for the third straight quarter of having negative year-over-year earnings
Yeah.
this quarter. Now it will be close. I think expectations are for -4%, and usually companies beat by about 3%. But do you think people are just kind of downplaying this, Brett, on the idea that number one, obviously, you got the supply chain being really crushed by these global trade wars, and number two, that 2018 was just kind of embellished because of the tax cuts?
I think that I don't know if people understand that, but I think that's true. So I don't know if they're downplaying it. In fact, if you look at the 10-day put call ratio when we started to get that ISM number, I don't think they're downplaying it. I think that they wouldn't see 5% cash if they were downplaying it. So I think that it is another thing that leads to a sense of potential prepotency for an upside breakout. And it's the same thing that you see. Expectations are low right now,
Yeah.
and positioning is not in any way aggressive. And again, as we always say, things will default to the economic cycle at the end of the day. And if things deteriorate, the market's not going to perform. But this is a context where people are assuming that deterioration. And if that deterioration does not come to pass, and if we start to get any hint of the opposite, then there's a vulnerability there to the upside. And this is just another data point that supports that.
All right. And then the last piece from it, Brett, we'll just take a quick look at the euro, which I know you have to short in. And I got a second question for you on it.
Okay.
Net 36% of investors say the euro is cheap. This was up from 31% in the prior month.
Does that really mean that 64% say it's expensive?
I
guess, right?
Maybe there's think it's Goldilocks right now at these levels here, and
Yeah, right.
it's just cheap. We only got one piece of it, but the add-on to the question that I had was, how do you think Brexit in was it 16 days or whatever? I mean, I'm assuming we'll get a kick the can down the road, but is the surprise deal struck for Brexit the biggest risk to your trade? Would you say?
No, it's the biggest
Or is it
opportunity for you
position?
to add to the trade.
Okay.
I mean, there will be a knee-jerk kick to the upside, and I think that then in the aftermath of that, there will be a process of gradually realizing that doesn't. I mean, that it's possible that takes no deal risk off the table. I don't think no deal risk is a big part of what the euro is doing right now, and in fact, I think that it lays down a framework for anybody leaving the eurozone, and I think that that could come to be something that makes it more likely for the market to start discounting the possibility that if we are going to see the type of economic growth that people are fearful of in other areas of this survey, that at some point Italy's going to want to do fiscal stimulus, and the European Monetary Union is not going to let them. And now they've got an example of another country that left the European Monetary Union in an amicable way. And so I think that actually increases the likelihood of exits and a possible existential risk for the euro.
All right. Okay, so with that then, Brett, we only got a couple minutes left. We'll go through the flow show here. Really, I thought the Fund Managers Survey had a little bit more important things to discuss. We get the flow show a little bit more regularly, but one of the items that was pointed out from it, um, they had the biggest asset losers from the last couple of sessions. IPOs down 12%, broker dealers down 5%, triple C high yielding bonds and leveraged loan ETFs. This is actually over the past 3 months, I should say. Now, the broker dealers, I would say there was that one-time news item which really hit them about them losing a revenue stream with everybody going to zero fees. But the comment was cracks are appearing in crucial liquidity and credit leadership. Um, I can't say I agree with that comment. And again, I guess how would you tie it into what we're seeing with all our comments about the other credit numbers and the people looking to push for capex investment?
I mean, maybe how you process the repo market action.
Yeah, yeah, that could definitely be in play here. So
I would think.
I don't know, it'll be something that we'll have to watch. For the flows for the week, 11.1 billion into bonds, 9.8 billion out of equities. I feel like
Once
a broken
again,
record every time we do this, but this brings 300. There was 322 billion inflows to money market funds in the past 6 months, which is the largest since the second half of 2008, which of course would have been around Lehman. Uh, do you take anything away from all that inflow into the money market funds the past six
You know,
months?
I think it's what we started with at the top of the show. I think that it is the widespread assumption that the way to understand that ISM data, which is considered to be probably the main leading indicator, if you look back the last several decades in terms of how it's popped up, that coming on the heels of a couple months ago seeing all these inversions in yield curves is a recipe for saying, we are unequivocally now at cycle end. And I think that seeing the money flows into money market funds would suggest a reaction to that. And the equity market's reaction to the ISM manufacturing number was much more dramatic than we've seen as a reaction to any single economic data point, I think, in several years. It was very clear. One economic data point hit, and we saw 2 days of, sort of quasi-crash-like behavior. And I think that confirming that sense of recession likelihood, reamping up those recession odds, I think that this survey, this money flow measure is really kind of showing the plumbing reaction to that process.
Okay. Moving back to the EPS models, forecast for the next 12 months is for a minus 3.3% decline. EPS is already in a recession, but there's talks about Asia exports that will likely flip year over year in November, December on base effects. G3 capital good orders showing signs of a trough. It's kind of what we were talking about with the semis there. Also, obviously, a dramatic decline in rates and oil helping boost global financial conditions. A little bit weaker oil there. So, you see anything in any of those comments with the EPS recession? And again, we're talking about risks to the upside. This Asia export call that they have there, it's certainly intriguing for, again, that 1% that's looking for the strong growth, right?
Yeah, sure. And I think just generally speaking, something I posted last week, I think the notion that we have interest rates where they are relative to dividend yields on the S&P is part of why you can see multiple quarters of essentially an EPS recession without seeing a strong market reaction, because anytime you get a dip, I think you have a lot of folks who are in a situation where they have to earn return on some kind of capital. I'm talking about pension funds. I'm talking about endowment funds. I'm talking about insurance companies. They manage billions and billions of dollars, and they have predetermined obligated payouts. And so they've orchestrated their process around the idea of being able to achieve some kind of return. And when interest rates tank below zero, in a lot of places, and down to one and change here, they need to find another place to get returns. It's just mechanical. And I think when you look at the S&P pull back inside of the a quantitatively expressible range and, dip quickly 5 to 6%, and the dividend yield on blue chip stocks is much higher than the 10-year rate, I think you're going to see a bid come in from places that aren't typical participants in the equity market. They don't want to be. They want to be in fixed income, but fixed income really isn't a possibility when everything is negative yielding because they're not going to play capital gains on the bonds. So we saw it in 2016, and I feel like if you look at the 10-year interest rate chart, generally speaking, you can see that there's the big dip in 2016 and there's the big dip now. And they basically, they got to about the same level. And in each of those cases, we saw strong deterioration in economic data, strong deterioration in EPS, and the market unable to move down very much. And I think that that's why. I think there's a relationship between where the 10-year is and where the average dividend yield is on the S&P that raises the floor for the stock market. So you get traditional equity-only market participants, in a state of panic and pushing put-call ratios way through the roof. But at the same time, you've got a new market participant and a new set of money flows that are coming in from other institutional investors who are looking to establish positions in dividend-yielding equities because they've got to earn some kind of return on their capital, and the fixed income market is just pricing them out of the equation. So I think that we've seen stability in the face of this compression in EPS performance because of what interest rates have done.
Okay. Real quick while we're talking here, Scalp got stopped out of 2 positions in his focus list, but for healthy gains in both, particularly in CCR. He stopped out of NGL for plus 10%. On his final, he also had trimmed at plus 21%. And then CCR, he got stopped out for a mere 123% profit. So well done by Scalp there. Yeah, he's pretty savvy when it comes to.
He seems to know what he's doing.
Yeah, he seems to know what he's doing, and he definitely he could smell a distressed play a mile away. So, well done by him. All right, last thing, Brett, and then we'll throw it in for you to tie it up with a nice tidy bow here. But since 1926, 5 occasions when U.S. growth stocks outperformed value by 30 percentage points in a 2-year period. Each foreshot a recession, was a warning for a recession. I know you and Scott hate these numbers because they mean something until they don't.
Say the fact again. Sorry, say the fact
Since
again.
1926, there have been 5 occasions when U.S. growth stocks outperformed value by 30 percentage points in a 2-year period.
Yeah. Data mining.
Data mining. Okay, fair enough.
All right.
So that's usually Scott's approach. I just like throwing it out at you just in case I catch you guys off guard here. But all right, Brett, you want to tie this one together for us then?
Well, yeah. I mean, I think it doesn't take much tying together. There's again. I am not necessarily wildly bullish on the market. I own an unleveraged portfolio investment long that I've owned since the middle of 2016, and I've continued to stay with that. So it allows me to be a little bit less aggressive when I'm bullish because I know that I'm making money if the market goes up. But I will definitely be looking for breakout setups in this type of environment, particularly after bearish headlines where I feel a sense that the tape is firm. And that's because of positioning, and that's what we've talked about. Positioning, the greatest vulnerability that positioning has right now is to the upside on a move of clear and sustainable reflationary impact in data. That doesn't mean that we're going to see that, and I'm not super bullish on the economy. I'm not super bullish on the cycle. I can fall into the same trap, but it's not necessarily a trap. It just means the vulnerability in asset prices is if everybody's wrong. And of course that's the case, because it looks so clear that it would be very difficult to spur dramatic and persistent expansion and growth from where we are, given that the data is deteriorating in the face of already overworked central banks around the world. And the United States is in an easing cycle now. I mean, everybody is doing the same thing. Interest rates aren't really responding a whole lot. Growth data is not really responding a whole lot. And I don't think that we can depend upon a particularly reflationary resolution to some of the global trade issues. So it doesn't necessarily mean that everything is going to come up roses, but it still is the fact that people are not positioned for those roses. And those roses would be the most dramatic impact on asset prices. That doesn't say anything about the probability of the roses blooming in the garden. It just simply means if you're going to take anything away from from researching where positioning is, you can't come up with the argument that people are exuberantly positioned right now. And that would be the argument that you'd see maybe in some persistently bearish publication that was trying to make the case that this is a bubble of some kind. It just isn't. It's remarkable that we can see such poor data and recognized by everyone as such poor data and very defensive positioning and not see asset prices decline a great deal. And again, I think there's explanations that have to do with the relationship between the average dividend yield and the rate of interest that we see around the world on risk-free debt. But it is still the case, one thing we didn't talk about, the American Association of Individual Investors bull ratio is now decisively below the level that we generally look at as extremely bearish. And that is as of last Thursday. And it's just sitting down there. We'll confirm that again on Thursday and see if that shifts a lot with this rally. It may rebound strongly. It may not rebound strongly. But, it's just another indicator of the same kind of idea. There's just nothing even close to exuberant speculative sentiment in the market, even though the market is now, I would say, just a sand wedge from all-time highs. And, that's the best way to understand this environment. There's definite risks, unquestionable risks, but people are already positioned to weather those risks.
All right. No, well said as per usual, Brett. So I'm seeing a headline. I don't know where it's coming from, but President Trump saying talks with China is going great. And financials will be phase 2. Not going to get too wrapped up in that. I don't see it being attributed anywhere. So my guess is it's somebody trying to get us to close above 3,000 and looking for that last 30-minute boost here. But all right, Brett. Well, look forward to talking to you next week. Obviously, we'll have a bunch more earnings to digest there, which should help shake up some of the sentiment a little bit, hopefully, and the markets as well too, and give us some trading opportunities here.
You got it, and it was nice for you to bring up Trichet.
Anytime we could mention Jean-Claude, we will. All right, I'll talk to you later, Brett. You take care.
Take care, Gav.